Thank you for tuning in to this conversation. It's a monthly appointment that we now have with the team at Motilal Oswal Wealth. Ashish Shanker, MD and CEO of Motilal Oswal Private Wealth, as well as Nitin Shanbhag, Senior VP and Head of Investment Products at Motilal Oswal Private Wealth, will talk to us every month on a note that they uh, put out every month, which is called the Alpha Strategist. A conversation that we didn't do in March was centered around budget. Then we did a conversation around, as we call, Vista, and you can see that conversation on our platform as well as read about it in the story that we've done around that conversation. And this time around, they're writing about something which usually has a telling impact and a positive telling impact on India when the prices are lower, which is crude. And they've done some interesting correlations and analysis, and I'll uh, try and ask them about some of the things that they've mentioned in this fairly long 72-page note. Ashish, Nitin, great having you, gentlemen. Thanks for joining in. Let's kickstart with the obvious one. It is known that a higher crude price is a headache for India, and a lower crude price is beneficial for India. What is the interesting piece that you guys came across when you dwell deep into this?
Yeah, so thanks, Niraj. Really happy to be here again. And I think this continuity is really good for your viewers as well as for us, because we can build on what we spoke over the last month or couple of months.
Yeah.
So like you rightly said, Niraj, crude is a very, very important import for India. I mean, it's the largest import item, and it does have implication in terms of the macros, and it also has implications on purchasing power of the country as a whole. So it also affects the demand side equation, and that subsequently has ramifications on different asset classes and how one should be building the portfolio. So this month we've dwelled on crude, and I just want to set some perspective before we go deeper, and Nitin can then dwell on the numbers, etc. Just to share perspective, see, if I just rewind back a decade, right, the crude import bill for the country was closer to 110, $120 billion, right, and around the same time, the total software exports for India was around $73-74 billion. Okay. Now, fast forward a decade to 2023. Today, our crude import bill would be around $120-130 billion. It's come off a little bit because of prices, and Nitin will share the exact numbers. But our software exports is now $200 billion, right? So that puts us in a very, very formidable position, because software exports minus crude imports, we are actually in a surplus of about $60-70 billion. And that is essentially, that coupled with certain other services exports, has led to a dollar chest of close to $600 billion. Now, this is a very, very good indication for the macro health of the country. Reason being that typically what used to happen is whenever we used to have outflows, or there used to be global turmoil, or interest rates suddenly used to go up, our central bank used to go into panic mode, right? And they used to be very, very reactive. If you remember 2013, what happened. But however, today, in spite of whatever is happening globally, and we've seen interest rates have shot up very aggressively, we've not panicked at all. I mean, we've been more constructive, we've been more proactive, and we are able to now, we have enough legroom to design a policy specifically for India and not react to what is happening globally. So this is a very, very big change, first of all. Now, second part is coming to the crude, and what has happened is, if you look at March, and this is a very big thing again, we've actually ended up in a current account surplus situation, and reason being that crude oil prices have come off, and partly it's also due to the special agreement that we have with Russia, that we've been able to import crude cheaply. Now, this is coinciding with 2-3 factors, and we briefly spoke about it, Niraj, last month. And that's the reason why my view on equities was quite constructive as opposed to probably at the beginning of the year. What is happening is, with crude oil prices remaining soft, obviously the inflation impact has been benign, right? And it's coming off. If you see month-on-month inflation numbers, now this has also impact on monetary policy, and globally we are seeing monetary policy moving to a status quo kind of a situation, and they may not cut rates immediately, but possibly now it's a wait and watch mode. And similar situation is playing out in India, and it's just being made easier by crude oil prices being benign, because the inflation impact is not that much of a worry going forward. Now, given this construct, I think equities after the correction in valuations look reasonably attractive, and so does fixed income. So before we go into the asset class view, I think maybe Nitin, you can just expound on whatever impact that you're seeing from a number point of view on crude.
Right. So if we take the long-term charts of where crude oil has generally behaved and its impact on various macro variables, you find that for every $10 rise in crude price, the GDP growth gets impacted by about 40 bips, inflation about 40 bips again, and your CAD typically by about 30 bips on the negative side. So we have a very sensitive crude connection is what we've really written about. And if you see where Brent crude was at its peak in around the same period last year, 2022, it was around the 120, 125 odd mark. Today it's trading at about 75, 77. So it's come off by more than a third. And that has a very, very positive impact, as Ashish just illustrated, across most macro variables in the country. And that is something that we will speak in detail about.
Yeah, viewers also remember that if indeed we did a conversation recently with Charles Gav of Gavical, was putting out this point that if India is able to do the trade with Russia in rupees and eventually use that as a template going ahead over the course of the decade with the OPEC or the Middle Eastern countries, then these equations also will change quite considerably. But as things stand, crude is arguably the largest sensitive item, if you will, that is there on India's plate. Now, just trying to understand, India is a bit of a how do I say, a benefit when dealing with Russia, simply because of the fact that Russian oil is not finding takers, and we probably get it at a beneficial rate. But it could be circa plus minus a few dollars from the rates that we have right now. Is there a view that your commodities team or the wealth team is taking in particular about what could happen to crude for the course of the year, primarily because of the fact that the OPEC output cuts haven't led to the price uptick that was anticipated? Sure, it bounced a little bit, but the concerns around the Western economies have brought crude prices back to circa $70 per barrel, as we saw this morning. So is there a thought around how this situation could unfold during the course of the financial year?
Right. As you know, Niraj, commodities, especially crude, is a very complex topic, and there are multiple variables which drive crude prices. OPEC is just one part of the supply side in the entire crude equation. Now, what is happening is that, on one side, we have access to cheap oil from Russia. So that's a good thing for India. But from a global context, what's happening is that you are trying to restrict supply in crude in an environment where the demand side is generally weakening. Right? If you look at what's happening in the West, whether it's China, whether it's the US, whether it's Europe, all these interest rate hikes have started to hurt demand, right? So there is a recessionary effect. And if you look at, there was one very interesting chart that was doing the rounds, which is the probability of recession across countries in the world. And India had 0% recession probability, but all the other regions in the world had a reasonable percentage probability of a recession. So the demand side is weak. So our team believes that going forward over the next few months, crude will generally probably tend to go up, because over the next few months, especially in the second half, probably things should start looking up. But however, the view is that it may not go up substantially to impact the equation on our macro balance sheet. So if it's $70 today, possibly you're looking at maybe $75, $80 crude, but nothing more than that. I mean, the upside is capped, which is really good news for India.
Now, Nitin, you mentioned about the impact on other asset classes as well. It always a hypothesis. Sometimes the hypothesis works, sometimes doesn't. So I'm just trying to understand, based on the thoughts that you guys have around what could the possible environment be, as Ashish just told us, what's the sense of what could happen to, or what's the impact of this big variable, standalone or otherwise consolidated, on the relative performance of the asset classes going ahead from where we are right now? I understand there are a lot of other variables which will also impact, but just using crude as a barometer for now.
Sure. So let me give you a chain of thought, eventually leading to equities, right? So we mentioned that there is certainly an impact on the current account deficit. Our current account deficit post the Russia-Ukraine conflict had gone up to as high as 3.7, almost 4%. And from there, in the third quarter of last fiscal, has come down significantly to about 2.2% of GDP, right? And that further is expected to narrow to close to about 80 odd bips, right? For the remainder of FY24, we believe that if crude remains in these kind of ranges, then we could hover at around 1.6% of GDP. Now, what that effectively means is that you're shoring up your forex reserves as well, right? From an external account perspective, India looks very well placed, because remember that any foreign investor, whether he is looking to make foreign direct investment or whether it's FPI inflows, you always take a brief look at the shield that is around the country, right? And our external account to that extent looks extremely healthy. Now, with that being built up, as I mentioned earlier, because crude is also important from an inflation perspective, we are not importing as much inflation as we were, let's say, 6 months ago. So most of our inflation is driven domestically. To that extent, we are finding that inflation, although fairly high, is unlikely to shoot up. And perhaps over a period of time can also come off. So from an RBI's perspective, I don't think our central bank has the kind of challenge that the US Fed has currently with its own inflation problems. And to that extent, what the debt markets are actually factoring in is around a 75 bips rate cut on the repo over the course of the next 1 year, right? And which could obviously happen in multiple parts, but 75 bips is a fairly significant number. So you're expecting 6.5 to go down to something like 5.75. And that's what is obviously being priced in. You see what has happened to the 10-year GSEC. Not too long ago was trading at about 7.4, 7.45, has today come down to very close to 7%. Briefly, it had even gone down below 7%. So the thing is that this has an extremely important effect on equities. Remember that interest rates are gravity as far as equity markets are concerned. As and when interest rates go up, they pull down the valuations for equity markets. And as and when they go down, equity markets tend to get a fillip. And hence, we believe that with corporate earnings remaining fairly healthy over the last couple of years or so, equity earnings, as well as the fact that interest rates are likely to trend lower, gives a very, very good cushion to equity market valuations. And as and when earnings obviously improve over a course of time, we could see equity markets headed up.
Just to add to that, Niraj, last month we discussed a lot about fixed income and the fact that fixed income is a great opportunity given where yields are. I think that's playing out very nicely. We do believe that somewhere interest rates would possibly have peaked out. And even now, for people who want to lock in yields, this quarter is a great opportunity. And we believe that interest rates will incrementally tend lower. The one point I wanted to make, and this was, I think, this question was also asked in the RBI policy, is that if you see the buying of gilts, right, RBI puts out a clear chart on who's buying. The others category, you saw a massive spike, almost 1.5 lakh crores of gilt buying, and that has pulled down the yields. Now, we don't know where this is coming from, but there is a very strong indication that this could be countries who are favorable to India, because over time, this de-dollarization topic is also going on. And India being such a large market, I mean, why shouldn't Indian gilts slowly start becoming a small part of the reserve ratios? So that's an interesting development. Too early, but let's see how it progresses.
Too early, but the fascinating space that we are all witnessing in our lifetimes, to be honest, gentlemen, if indeed we go down that path of being able to do some of these things, I mean, material from our economy's perspective. So just wondering, therefore, before we wrap up, the last month that we spoke, there was this interest in multi-asset portfolios, multi-cap portfolios within equities, and bullishness even on precious metals, gold and silver, both gold more so than silver, if I'm not wrong. Now, my question is, by virtue of the fact that inflationary pressures are looking a lot more lower, WPI was just negative month on month, and the recently released 15 minutes over half an hour ago. Just trying to understand, is on a relative basis, is the gauge shifting slightly more in favor of one over the other? I know 1 month is too short a time frame. Just trying to understand, because lots happening these days in 1 week than what usually happens in a year.
So we have this temperature gauge concept, which is basically a simple way to look at equity valuations in the country. This month it is at 107, right? And 100, between 100 to 120, basically equities are in a reasonable valuation range. So our stated action to clients is whatever incremental equity you want to invest, you can put in 50% lump sum today, 50% staggered. But having said that, my view is, Niraj, that I would be more scared to be out today than be in. Reason being that a lot of the macros are turning favorable for markets. You've seen 18 months of consolidation. 1 year forward Nifty valuations are 18 times, which is lower than long-term averages. And the broader markets are looking very good after this correction. So generally, very, very favorable on, more favorable on equities, to answer your question, than all the other asset classes going forward. Having said that, given the complex dynamics globally, right? Globally, the situation is a little different. It does merit, having diversification across asset classes, as we spoke last month. But definitely, equities is looking incrementally that much more attractive.
Okay, Nitin, I'm throwing this out of the blue at you. I'm still trying. I don't know if you have an answer, but let me just try nevertheless. Is there a straight correlation between certain components within the equity basket to perceived trajectory of inflation and rates? I mean, the market, of course, gives prominence to real estate, maybe to NBFCs at the turn of a cycle downwards. It may have happened in the past. Do you guys sense, by virtue of data that you've analyzed, that might well play the course this time around as well?
Yeah, of course, because if you see what has happened in 2022, the way rates have gone up, not just in India, but globally speaking, you've had a distinct change in the style that a lot of fund managers were catering to, right? So traditionally, it used to be the growth-oriented businesses, high quality, which traditionally did well because of low cost of capital. And suddenly, over the last year or so, you had the value side of the equation coming up, which is largely your cyclical businesses, your private financials, your industrials, your capex. All these kind of businesses have now started to look good, and that's how sensitivity of rates really works on equities. Obviously, from an Indian standpoint, I think where we are placed at an overall basket, if you look at the headline index numbers, the earnings will definitely be driven by banking. And that, to our minds, is extremely strong because you've had a huge major cleanup as far as asset quality is concerned, and to that extent, the lending growth, the credit offtake that we are seeing so far is fairly encouraging. We'll have to see how it plays out, but predominantly the next year or so will be driven largely by banking.
Okay, gentlemen, before we wrap up, quick 30 seconds. It's a long note, so it's okay for me to ask you, is there a very interesting number or a statistic that you may have included in the report which I've missed out on asking you? A standout feature of the note that you might want to just share before if we have discussed it, great, but if we haven't, is there something that we missed out?
Two important points, let me just take it. One is, if you look at the peak of Nifty in October 21, you were at 18,000 then, you're back to 18,000 odd levels. As far as the headline indices are concerned, they haven't done much. But your earnings growth has gone up by close to 30% during that time period. Effectively speaking, your valuations, which is your P, has dropped by about 23%. And I think that is the telling construct of what we tried to put, that, from a broad-based standpoint, price movement may not have happened, but the underlying fundamentals are so much in your favor.
Yeah, absolutely.
Well, cross fingers for this period of consolidation to not remain as painful as it would have been for select players in the last 18 months. But gentlemen, thank you so much for sharing your thoughts. It's lovely to read the Vista note about the different asset classes. Lovely to read this crude note as well. All incrementally positive for India. It's always good to see that. Thank you so much for speaking to us today.
Thanks, Niraj. Pleasure speaking to you as always.
Likewise, and viewers, thanks for tuning into this conversation.